Hello everyone. Today I will present a short overview of the paper No Sabotage under Conditional Mean Risk Sharing of Dependent by Mixture Insurance Losses by Denuit, Ortega Jimenez and myself, published in IME Journal online in December 2025. The general theme is risk sharing in an insurance pool using what is known as the Conditional Mean Risk Sharing Rule. The key question is implementability. When the rule is applied in practice, can participants manipulate the mechanism by misreporting losses? The paper shows that such manipulation, called sabotage, can be ruled out under verifiable sufficient conditions, even when losses are dependent and heavy-tailed. I will focus on the common mixture framework, 3 methodological approaches, and a heavy-tailed illustration based on the Type 2 Mardia-Pareto model. I will first summarize the main message and why no sabotage is central for conditional mean risk sharing. The starting point is the conditional mean risk-sharing allocation. We observe individual non-negative losses, x1 to xn, and the aggregate loss S, which is simply the sum of all individual losses. The allocation rule assigns to participant I the conditional expectation of their loss, given the realized total loss S. Intuitively, once we know the total loss in the pool, we ask, on average, how much of that total comes from participant I? That is the amount participant I is charged ex post. This rule is appealing because it provides risk reduction for risk-averse agents. Instead of facing their own volatile loss xi, they face a smoother payment MIS linked to the pooled total. However, implementability requires a monotonicity property called the no-sabotage condition. The function that maps the total loss S to the payment MIS must be non-decreasing. If it decreases on some range, a participant might have incentives to inflate their reported loss to reduce what they pay. A classical sufficient condition for no sabotage is independence plus log concave densities, known since the work of Efron and Lehman, but log concavity implies light tails, and many insurance losses are heavy-tailed, so those classical arguments can break down. The paper addresses this by focusing on dependent by mixture risks. Losses become dependent through a latent systemic factor, while remaining conditionally independent, given that factor. We propose 3 complementary toolkits to obtain sufficient conditions for no sabotage, and they show an important heavy-tailed success story using the Type 2 Mardia-Pareto family. Let me detail the mechanism. We have a pool of n agents, each one exposed to a non-negative random loss. The aggregate loss S is the sum of these losses. The conditional mean rule allocates the realized total S through functions MIS, where each MIS is the expected value of xi conditional on the event the sum of all losses equals S. The key requirement is monotonicity. For each I, my should be increasing with S. This is the no-sabotage property. The intuition is simple. If the pool experiences a larger total loss, it should never happen that some participants' allocated share decreases. If such a decrease existed, the participant could benefit from strategic behavior, for instance by exaggerating their declared loss when the total happens to be in the decreasing region. This is undesirable from the perspective of mechanism design, fairness, and stability of the pool. So the main objective becomes, can we find sufficient checkable conditions under which EMIS is increasing when losses are realistically dependent and possibly heavy-tailed? The key modeling framework is dependence by mixture, also called a common mixture model. The idea is that dependence arises through an unobserved or latent systemic environment variable, typically denoted by lambda. Conditional on the environment lambda, the losses are independent, so the joint conditional density factorizes as a product of the individual conditional densities. But unconditionally, when we integrate out lambda, the losses become dependent. This modeling approach is natural in insurance because many risks share exposure to common drivers, catastrophe intensity, macroeconomic cycles, pandemics, climate conditions, or general claim inflation effects. The goal is to understand when the allocation functions might remain increasing, even though the unconditional joint distribution may not satisfy classical log concavity conditions. This figure illustrates the modeling philosophy. Each participant has their own loss, xi, but all losses are connected through the same systemic factor, lambda. You can think of lambda as the overall stress level of the year. In a calm year, lambda is small, and everyone tends to experience smaller claims, while in a stressful year, lambda becomes large and many claims become simultaneously large. This creates positive dependence, and the main intuition of the paper is that positive dependence can actually help with implementability. It can remove sabotage situations that appear under independence, especially when losses are heavy-tailed and heterogeneous. To prove monotonicity of MIs, the paper uses stochastic order theory. A strong way to guarantee no sabotage is to show that the conditional distribution of xi given S Poisson becomes larger as S increases. The simplest formalization is the usual stochastic order. For S1 less than S2, xi given S res 1 should be stochastically smaller than xi given S res 2. This is sometimes called Efron's monotonicity. An even stronger sufficient statement is monotonicity in the likelihood ratio order. Likelihood ratio ordering implies stochastic ordering, and it gives powerful tools for proving monotonicity of conditional expectations. The paper's strategy is to establish sufficient conditions under which these orderings hold for dependent by mixture models, and then deduce that MIS must be increasing. I now move to approach 1, which is based on total positivity, density properties, and a posterior tilting argument. Approach 1 focuses first on the bivariate case, with only 2 risks. This is not only a pedagogical simplification, it is also mathematically important because many dependence arguments can be reduced to bivariate checks, and because sabotage issues can already appear with 2 agents, we consider the joint density of x1 and x2 and define the sum S Mueller x1 plus x2. The key object is the joint density of x1 and the sum S, which can be written as a function of x and s by evaluating the joint density at the point xsx. If this bivariate function is totally positive of order 2, abbreviated TP2, then the conditional law of x1 given S deciphers is increasing in S in the likelihood ratio sense. This implies no sabotage. The conditional expectation of x1 given S deciphers is increasing in S. So TP2 provides a powerful order-theoretic bridge from density shape properties to monotonicity of the allocation rule. To make TP2 verifiable, the paper provides an equivalent smooth condition when the density is sufficiently regular. Instead of checking TP2 directly, we can check an inequality involving second derivatives of the log of the joint density. In words, the condition compares a mixed curvature term, linking both variables, with a pure curvature term in one variable. When the positive dependence curvature dominates, likelihood ratio monotonicity holds. This result generalizes the classical independent log concavity case. Under independence, the mixed derivative is 0 and the condition reduces to concavity of the log density of the second risk, which is exactly log concavity. But in the dependent case, the positive dependence term can compensate for non-log concavity, meaning that dependence may restore monotonicity even with heavy tails. When the joint density arises from a common mixture model, the paper introduces a key probabilistic tool, the tilted mixing distribution lambda xy. The definition is as follows. Given we observe the values x and y for the 2 losses, we update our belief about the latent environment lambda. The posterior distribution of lambda, given the observation, is proportional to the prior distribution of lambda multiplied by the conditional likelihoods of observing x and y under that environment. In other words, environments that make the pair, xy, more likely receive more posterior weight. This posterior mixing law is denoted lambda xy. It is the correct conditioning object to rewrite the mixed derivative of the log joint density in a transparent form. So the key message is, in a common mixture model, checking monotonicity can be translated into checking properties under the posterior environment implied by observed losses. Under that posterior environment, lambda xy, the paper proves a covariance representation. The mixed derivative of the log joint density can be expressed as a covariance between 2 quantities, roughly the sensitivity of the log conditional density of x1 to x and the sensitivity of the log conditional density of x2 to y. This is powerful because it converts an analytic derivative condition into a probabilistic dependence condition. If the conditional score functions move together positively under the posterior environment, the covariance is positive and the TP2 type condition is more likely to hold. Practically, In parametric mixture models, these score functions are explicit. So one can often check monotonicity by bounding this covariance analytically or numerically, instead of manipulating complicated unconditional densities. I now move to approach 2, which derives monotonicity conditions using conditional expectations and monotone mixing arguments. Approach 2 operates at the level of conditional expectations rather than derivatives. The idea is to keep lambda explicit and then use iterated expectations. The first requirement is that if we fix both the total loss S and the environment lambda, then the conditional expected contribution of agent I should be increasing when S increases and also increasing when the environment becomes more severe. This is a conditional version of no-sabotage. The second requirement is that the environment lambda itself should become stochastically larger when the realized total S is larger. Intuitively, observing a larger total loss should shift our belief toward larger systemic stress levels. If both conditions hold, then when we integrate out lambda, the unconditional contribution function MIS becomes increasing. So this method provides very flexible sufficient conditions, and it is well suited to credibility type models that are common in actuarial practice. The paper illustrates approach 2 with two classical exponential family mixture models. First, in a Poisson common mixture model, the conditional losses are Poisson with mean proportional to lambda. When we condition on both the total claim count and lambda, the expected share of participant I in the total is simply proportional to their intensity parameter. This expectation is linear in S and therefore increasing. In addition, standard results in credibility theory imply that the posterior distribution of lambda, given the sum shifts upward when the sum increases, so the second requirement holds. Second, in a gamma common mixture model for severities, the same phenomenon occurs. Conditional on the sum and lambda, the expected contribution is proportional to shape parameters and linear in S. Again, monotone mixing holds in typical settings. These examples highlight that the paper's conditions are not purely abstract. They connect directly to standard actuarial mixture models used for counts and severities, even when some parameters lead to non-log concave densities. Finally, I present approach 3, which uses size biasing and a likelihood ratio comparison of aggregate losses. Approach 3 uses a representation based on size-biased transforms, following results in earlier work by Denuit and Robert. The core insight is that the conditional mean allocation function can be expressed as a ratio involving the density of the total loss under the original model and the density under a size-biased version of the model that gives more weight to outcomes, where participant I's loss is large. So to show MIS is increasing, it suffices to show that the aggregate loss under the original model is smaller in likelihood ratio order than the aggregate loss under the size-biased model. This is a very elegant mechanism design interpretation. To prove no sabotage for agent I, compare the baseline pool with the pool where agent I is artificially made larger. If the size-biased pool dominates in the likelihood ratio sense, then MIs must increase with S. In common mixture models, size biasing preserves the mixture structure, which makes the approach practically usable. I now illustrate the conclusions on a heavy-tailed model, the type 2 Mardia-Pareto distribution. The type 2 Mardia-Pareto family is a multivariate, heavy-tailed model used to represent dependent risks with Pareto-like behavior. Its survival function depends on the sum of scaled coordinates, which immediately indicates strong tail dependence. Large losses tend to occur together. Crucially, it admits a scale mixture representation. Each individual loss is a product of a systemic scale factor, lambda, and an idiosyncratic component, wi. Given lambda, the wi are independent and exponential, which makes the model a natural common mixture. The key message is that this dependence by mixture structure satisfies the no-sabotage requirement under the conditional mean risk sharing rule, despite heavy tails. This is in sharp contrast with the independent case. If we keep the same marginal distributions but remove dependence, the conditional mean allocation can become non-monotone, producing sabotage opportunities. In the bivariate case with two participants, the paper provides a closed-form expression for the allocation function of participant 1, namely the conditional expectation of x1 given the sum equals S. In the slides, this corresponds to equation 2. Rather than reading the formula, the important point is what it enables. It allows us to study monotonicity directly and to understand how parameters such as the tail index alpha and the scales sigma 1 and sigma 2 influence the shape of the allocation function. The explicit expression reveals how the heavy tail and the dependent structure interact. In particular, even when heterogeneity in scales is strong, the mixture-induced dependence can stabilize the allocation function, preventing decreasing regions. This analytical tractability is one of the attractive features of the Mardia-Pareto example. This figure provides a clear visual message. The horizontal axis is the total loss S. The vertical axis shows the contribution assigned to participant 1. Two curves are plotted. The yellow curve corresponds to the dependent by mixture Mardia-Pareto case, and it is increasing. That means no sabotage holds. Larger total losses lead to larger assigned contributions. In contrast, the other curve corresponds to the independent version with the same marginal distributions. It exhibits a decreasing region, highlighted in the plot and magnified in the small zoomed panel. This is exactly where sabotage can occur. In that region, if the participant can increase their reported loss and thereby increase S, they may paradoxically decrease what they pay. So the dependence induced by a common systemic factor is not just a modeling detail. It can fundamentally change the implementability of risk-sharing rules under heavy tails. I conclude with the main takeaways and some open research directions suggested by the paper. To conclude, the paper delivers a systematic analysis of no sabotage for conditional mean risk sharing under dependent by mixture losses. It proposes three complementary approaches. Approach 1 relies on total positivity and converts derivative conditions into covariance conditions under a posterior tilted mixing law lambda xy. This is technically powerful and conceptually clean because it links monotonicity to positive dependence properties. Approach 2 uses monotone conditional expectations and monotone updating of the environment variable, and it connects naturally to credibility type mixture models such as Poisson and gamma mixtures. Approach 3 uses size biasing and a likelihood ratio comparison of two aggregate losses, giving an elegant characterization of no sabotage in terms of dominance between a baseline pool and a size-biased pool. The heavy-tailed type 2 Mardia-Pareto case illustrates the main insight. Positive dependence induced by a common factor can remove sabotage regions that appear under independence, even when the marginal distributions are heavy-tailed and heterogeneous. Finally, the paper highlights open problems, including understanding how no sabotage and risk reduction behave as the pool size increases under dependence and heavy tails, and characterizing broader tail-dependent severity models where implementability can be shown in a similarly explicit way.